Good afternoon, everybody, and welcome to the latest installment of our Stowe and Degon webinar series. I'm Marty Coyle, a partner here at Stowe and Degon, and I'm happy to be the moderator of this panel. Today, we're going to talk about part 2, the lease accounting rules. Last month, we did an overview. Today, we will do a deeper dive. Our speakers today are my colleagues, Keith Erickson and John Reardon, who did a great job last time and will continue to do a great job this time. Little housekeeping before we get going. We welcome questions. We want all your questions. We ask that you put them in the Q&A box, type them in, then we'll know who they came from. We are not going to answer questions until the very end. That seems to work the best for us. So about quarter of one, we will start the questions, maybe 20 of one. If we don't get to all your questions, we know who sent them, so we'll be able to get back to each and every one of you. Also, the presentation is being recorded, and if you'd like a copy, you'll be able to go back and watch it or show it to colleagues in your offices. And then there'll be a short survey at the end. We would appreciate it if you give us feedback so we continue to provide good content for you in future webinars. Last thing is a little disclaimer. This is a deep dive overview of the new lease rules. We can't obviously go over everything in this 45-minute to hour presentation. We're going to go over a fact pattern, one fact pattern, and your company might have a much different fact pattern. But we're going to do everything we can to help you understand the basic rules that you need to follow to deal with ASC 842. And obviously, if you need help, please reach out to your contact at Stowe and Degon. We'd be happy to assist you. So I'm now going to turn the presentation over to my colleague, Keith Erickson. Take it away, Keith.
All right, thank you, Marty. As Marty indicated, that this is going to be a much more detailed program than the one where we introduced the topic a month or so ago. We're gonna try and talk, about the general requirements of analyzing your leases, analyzing contracts, and determining what classification they fall under, how to do the calculations to record your right of use asset and your right of use liability, whether it's a finance lease or an operating lease. You're going to have a liability now on your balance sheet that didn't exist, and you're going to have an asset for operating leases that did not exist in the past. There are some practical expedients that allow you to take a few shortcuts, nothing too significant. The FASB doesn't like to make anything too easy, but especially for private companies, I think they are leaning a little bit more towards making things a little bit more user-friendly. We're going to talk about the accounting policy elections that are available. We're going to talk about, how you go about measuring the value, the fair value of the right of use asset and the right of use liability that goes along with that asset. It's, the lease liability. And then we'll discuss what adjustments may be necessary at adoption. And then, if you're in a circumstance where your leases are modified, if there's some sort of change that was unanticipated when you initially entered into the lease, there may be some accounting there that in the past, there really wasn't all that much to do except start making your new payments. Now there's a little bit more involved with that. And then as part of that, some of those modifications required to handle that particular change as a brand new lease. Others, you don't have to indicate that it's account for it as if it's a brand new lease. Next slide, please. So the finance lease was always known as a capital lease, and that was, somewhat intuitive. We're basically financing typically a piece of equipment. You could also do that with a building. And if you were basically getting substantially all of the remaining economic life of that asset, and the payments were a substantially significant portion of the overall fair value of that asset, they treated it as if you were buying the asset and taking out a loan, and you would record a capital lease on your balance sheet, and you record the asset along with other fixed assets in your balance sheet. The criteria under the new pronouncement for classifying a finance lease, basically they're similar. The wording's a little bit different. The percentages are a little bit different. You will classify your new lease as a finance lease, assuming that ownership transfers to the underlying asset by the end of the lease term. That's very intuitive. That makes sense. If the lease grants the lessee an option to purchase the asset at the end of the lease for a price and under terms that it's virtually assured the lessee would take advantage of it, that's one of the criteria. If the lease term is greater than, equal to, or greater than a major portion of the remaining economic life, and they use 75% as the cutoff, then you would want to classify that lease as a finance lease. Now, there is a caveat there. If the economic life of the asset that's remaining is very short, and you're only getting the use for a small time overall, then that particular criteria element does not apply. If the present value of the sum of all the lease payments and any residual value guarantee is significant to the fair value of the asset, and the number they use in the pronouncement is 90%, then again, you'd classify it as a finance lease. And one other item that they've added is basically if it's an asset that is so specific to your needs, if it's a custom built asset, primarily, and that at the end of its life, you or no one has any other potential use for that asset, that would be one of the criteria for a finance lease. The operating lease is basically anything that's not a finance lease. So if you're sure it's not a finance lease and it's worth your time and effort to make sure that all these criteria, none of these criteria apply to your lease, then it defaults to be an operating lease. The other components of this is that in order to be classified as a lease, it has to cover a specific asset. One of the things you may have is an agreement to have some warehouse space. If you have, I know in pharmaceuticals, sometimes they have third parties that do the compounding or the mixing of the pharmaceutical, and they hold it until shipment. And they'll hold it in their warehouse, and they take inventory and they report back to you. However, you don't necessarily have control over a specific area within that warehouse. So in those circumstances, that would not be a lease. That's just another sort of contract. You don't have control over a specific asset. If you were leasing within a building, a very specific area, obviously an office space is that type of thing. But even within a warehouse, if you had an entire floor and you could control access to that floor, what assets you were putting on that floor, and how to distribute those and that sort of thing, then that would be a lease, and you'd go through the criteria to determine if it's an operating lease or a finance lease. The other thing is that a lessor cannot substitute other assets at their own convenience. And so what that means is basically if you're leasing, say you're leasing vehicles, and it's very specific vehicles, which vehicles you have the VIN numbers, and there's not typically going to be any substitution. If it's a type, and if it's the type of thing where I don't want to say this. I don't want to go too far down that path. I'm stumbling over what I was going to say. If the assets, hold on a second. Let me just find my notes. I apologize. Yeah, so if the lessor can substitute at their own discretion completely, that's typically not a lease. If the supplier has a right to substitute at a specific date, in other words, I'm going to go back to my automobile lease. If you're leasing vehicles, and every 3 years your agreement says you get new vehicles, but then again, those vehicles that are coming in after that 3-year period are also going to be specifically identified, and you control those vehicles, then you will be, still considering that to be a lease. Getting back, a capacity portion of an asset, if you have access to a pipeline, but it's general access, it wouldn't be a lease. But if it's a tangent off of that pipeline that gets a product directly into your facility, then the lease for that tangent could potentially be classified as a lease. All right, next slide, please. Okay, so the transition takes place at the earliest period presented after December 15th, 2021. So for most companies, calendar year companies, it takes effect January 1st, 2022. Now, there's 2 ways to transition. If you're preparing comparative financial statements, comparative balance sheets, the preferred method is to go back and calculate the right of use asset and the lease obligation liability as of the beginning of the earliest period presented. So in your 2022 balance sheet, you would potentially have, your 2021 balance sheet comparative showing what the asset value would be at the end of 2021, and then again at the end of 2022, the revised amount after having made payments, which obviously reduced the remaining life of the asset and the remaining amount outstanding on the liability. You are allowed to do a adjustment just in the current year presented, but then you've got to go through the process of disclosing what it would have looked like had you done it the other way anyway. So there's not a lot of savings there. You still have to do the calculations. And it's, I think in our opinion, it's a cleaner look if you just go ahead and show the comparative figures the way they would have been had you adopted it, a year prior. Next slide, please. So this is the practical expedience. This will save you, especially if you have a number of leases, a significant amount of time. Basically, if whatever leases exist on the date that you implement this, typically again, January 1st, 2021 and 2022, you don't have to go back and just double check the classification. Anything you already have classified as a capital lease will automatically be considered a finance lease. And you don't need to do a reclassification as to operating or finance. And same is true for anything that's already an operating lease. You don't have to look to see if perhaps there's something that would have triggered it being a finance lease under the new pronouncement. You do have to go through the process of calculating what the fair value is and put the the values on your balance sheet. But again, you don't have to double check the classification. Any lease that has expired before adoption, you don't have to recheck the classification and account for. And any initial direct costs would not be reconsidered for existing leases, because under the new pronouncement is accounting for those initial direct costs of obtaining the lease. And in the footnotes to your financial statements, where you're discussing your leases, you will disclose the election package that you chose when implementing the pronouncement. One other thing I do want to point out, because most private companies don't have the same reporting requirements that public companies do, where they have to report to the SEC quarterly. So you may be thinking, well, even if I'm adopting it January 1, 2022, I don't really issue my financial statements until February, March, April of 2023 after my audit's done. The problem that you may have with that is if you do have bank covenants and you're reporting more frequently to the bank, and it's expected that you're reporting under US generally accepted accounting principles, US GAAP, then those monthly or quarterly reports that you send to the bank need to address this. And that's why we wanted to get this program out at this time of year, because I think it's important that for the leases you have and for potential leases coming up, you are able to do these calculations, see what the effect will be on your balance sheet. And we would suggest that perhaps at that point you recalculate your debt covenants that have balance sheet ratios and determine whether or not some of those covenants that may pass under the current guidance may not pass under the new guidance. And that's a point in time where you would probably want to address that with your banker sooner than later to see if there's some sort of amendment or other way to deal with the issue of that non-compliance that is basically just a result of a new accounting pronouncement. Next slide, please. Okay, so the accounting policy elections, basically, you can elect not to separate lease and non-lease components. So obviously, you've got a basic lease payment, you've got common area maintenance costs many times, you may have real estate tax, things like that you're required to pay as long as you're leasing the property. So this allows you to elect to either include those in your minimum payments or to just account for those separately, so that when you do the calculation of the fair value of the right of use asset and the liability, you're only using the lease payments that are expected to be made as long as you are the occupant of the property or as long as you're using the asset that's under lease. You're also allowed to exclude short-term leases with less than 12 months from application. So you would not have to go through the exercise of calculating the right of use fair value and the liability fair value for a short-term lease. The question often comes up, well, should I just structure all of my rental agreements as 12-month leases? The short answer is no. We'll touch on that a little bit more on a slide that's further down in the package. And then, for ease of use to some extent, if you do have auto leases, office equipment leases that are significant, the FASB does exclude immaterial items. So if your leases are a handful of copiers and it doesn't add up to an amount that would be material to your balance sheet or P&L, those can be excluded. But if you do have groups of assets like that are very similar, they allow you to take a portfolio approach. So you can basically analyze a master lease or groups of very, very similar leases, particularly if they're with the same supplier, as basically one right of use asset and right of use liability, and do the calculations based on what the fair value is going to be based on all the payments involved with those agreements. Next slide, please. So this shows, and we touched on this in the first program. This shows how you go about measuring the lease liability and the right of use asset. John's going to get into the nuts and bolts of the accounting and what it's going to look like. But basically, it's all based on present value. So you're going to have to determine what are the total payments that you're going to make. What is a reasonable discount or interest rate? Now, if you have other borrowing, you can determine what a reasonable rate is based on your current incremental borrowing rate. If you've already got equipment loans, if you've got a line of credit, if you've got leases with an implicit interest rate, you should take that into account in determining your discount rate. The total payments portion of this Again, this is where you really can't look at getting into single year rental agreements just to avoid this, because the FASB, didn't want to allow that loophole to exist. Basically, if you're in a situation where you're in a building and the cost and effort that would be necessary to move would prohibit you from doing so, you really have to determine how long are you going to stay there and have 1 year leases, so to speak, or how long are you really going to need to occupy the building or use the piece of equipment. If it's an agreement with built-in options to renew and extend, you have to come up with the most likely scenario of how long you plan to continue to renew and extend those, and use that in your analysis as to the total payments and the discount rate. Once you calculate the lease liability, you're going to have an offsetting right of use asset. And again, John will get into the nuts and bolts of the accounting. They both basically amortize down over time until the end of the lease. Next slide, please. So adjustments at adoption. Generally, it would be unlikely that you would have an adjustment that would affect beginning equity or your P&L when you do the cumulative effect adjustment for the right of use asset and the lease liability. There are some circumstances that I've seen it result in an adjustment, but those are few and far between, and there's not a good scenario that we would want to discuss here. If your leases are that complicated, you need to contact us or your own trusted advisor, because you want to make sure that you're getting it right. Basically, the adjustments you're going to see are the beginning balances of right of use asset and a lease liability, and you'll have a current portion and a long-term portion of the lease liability. The adjustment, the right of use asset is not to be buried within the fixed asset classification on your balance sheet. You should have a separate line item. If your fixed asset, if your fixed assets are one line on the balance sheet net, you want to have a right of use asset listed there, and it would be separate also if you're detailing your fixed assets in your footnote. It should be clear the right of use asset is separate from your other property, plant, and equipment. Next slide, please. So again, the adoption date. Oh, well, actually, this is John now. John, this is the example. John's done a lot of work to come to a good understanding of this. He's our go-to guy to assist clients in this area, and he's going to walk you through this set of circumstances and the example that we've put together.
Okay, thanks, Keith. Now we're going to walk through a detailed example, and some of these things may not apply to your particular situation, but they're just up here for illustrative purposes. Assuming that you're going to adopt using the ASU exception provision to do it as of 1/1/2022, monthly lease payments are, that should say 10,000, I think, due on the first of month. Payments increase. Oh, no, I'm sorry, it is 100,000. I'm sorry, 100,000 due on the first of the month. Payments increase $10,000 on the first day of every new year. Lease terms for 60 months. This particular lease does have some non-lease components, some common area maintenance, and you're electing not to combine them, to treat them as part of the lease, but you're going to treat them separately. The estimated rate of those expenses is 21%. The fair value of the asset at adoption is $6 million. There's an estimated residual guarantee of $15,000. You currently have unamortized initial direct costs as part of securing the lease on your balance sheet right now of $35,000. You have an existing deferred rent liability as the result of straight lining the rent to gap of $100,000. I mean, a lot of leases have escalation payments like this one, and there's a period of free rent under existing gap. You're straight lining that to show an even level expense over the course of the lease. You have unamortized lease incentives on the balance sheet of $20,000. The discount rate used in the lease is 10.82%. That is the rate that is implicit in the lease. You happen to know what that is. If you do not know what that is, like he said, you use the incremental cost of borrowing. It should be the incremental cost of borrowing for a similar type asset over a similar type term. So if you have a 30-year mortgage on another facility somewhere that you're paying 3.5% on, and you're talking about a lease of other warehouse space for 5 years, you're going to have to do a little bit more work, maybe reach out to your banker to find out, okay, what would the rate you get be, because those would not be comparable terms. Next slide, please. Okay, the first step in measuring the lease is to measure the right of use liability. You need to schedule out over the course of the lease the actual monthly payments. And then you can see here, starting in payment 1, we decrease it from 100,000 down to 79,000. That's to reflect the fact that we have elected not to combine the non-lease components with the lease. You multiply that by a present value factor, which would be determined based upon your discount rate. And that gives you the discounted amount of the payments, all the way up through payment 60, which is the last payment of the lease. And then don't forget, you need to discount back the residual guarantee, which at 15,000 would only be $8,700. The total of those payments discounted back at the 10.8% is $4.3 million. That is the starting point of measuring the right of use asset. Let's flip to the next slide. Okay, your right of use liability, the 3437, less any deferred or accrued rent you have on your balance sheet, plus any unamortized indirect cost, 35,000, less any unamortized lease incentives, gives you your right of use asset, the $4.2 million. Next slide. These would be the journal entries you would make. You record the right of use asset, the right of use liability. You wipe off the accrued rent or deferred rent. You roll the wipe off the unamortized indirect costs. You wipe off the lease incentives, and you establish the right of use asset. Next slide. Here's the part that gets a little bit tricky. Okay, the next step is to figure out over the course of the lease what the total cost of the lease expenses are. This is, I'm sorry, I should have prefaced this earlier. This is all for an operating lease, not a capital lease, not a finance lease. This is all operating lease we're talking about. Under the standard, the operating leases are structured so that you recognize a constant amount of expense over the term of the lease. So you start with the total undiscounted payments that you're going to make over the term of the lease, add in the residual guarantee that you're likely to make, less any unamortized indirect cost, less the deferred rent, less the unamortized lease incentives. The total cost of the lease over the 60 months is the $5.6 million. Divided by 60, that gives you on a straight line basis a monthly lease expense of $93,633. That's the amount that's going to be flowing through your P&L every single month. How you get there is a little bit different. Next slide, please. On your balance sheet, you have the lease liability. You're going to be accruing interest expense on that liability and accreting that liability up every single month based on the amount of interest expense. The difference between the amount of interest expense and the monthly lease payment, the monthly lease expense that we just calculated, is the amount that gets offset to the asset. Either, I guess note whatever, you put it to a right of use asset accumulated account. See, the combination of the two equals the $93,633. And the actual cash payment to cover the lease is just a simple balance sheet cash lease liability. And you will notice, because the interest rate changes over time, the amount of the amortization to the right of use asset changes over time. So this isn't just as simple as throwing this up on your fixed asset schedule and depreciating it like you would for a finance lease. You actually have to go through a little bit of work here and figure out the amounts, individual amounts for the interest and the amortization component. Next slide. And I think it's back to you, Keith, for the modifications and remeasurements.
Yep, thank you, John. I was hoping you were going to talk slower. I'd have less time to take up. No, thank you for
I
that.
can do it
I
again.
think that, you know, that last slide that showed the actual mechanics and accounting and of the new methodology is something that's going to be, you know, so different for the average controller and bookkeeper. And that's why this is such a cumbersome process. You know, in the past, you made a lease payment, you credited cash and debited lease expense, and now you're going to have to deal with amortization tables and recording. You know, that even though it ends up being roughly the same amount of expense, it's hitting many more accounts. So that's the part that's just not intuitive to the average person. Modifications and remeasurements. So basically, if there's some sort of modification, a change in the lease, then you know you have to determine what type of change it is. Does it result in having to basically account for something as a brand new lease, or is it something where you just have to make adjustments to your existing lease accounting? And you know what that means is if it's a new lease, it may result in terminating the old lease, and you would just replace those balance sheet amounts with the new ones. If it's a modification, it's similar in that you have to basically recalculate the new fair value based on the modification. So the type of things that result in having to record a brand new lease are if the modification grants the lessee an additional right of use that wasn't included in the original lease. So if you had space in a warehouse or space in an office that took up 30% of the building, you expanded and you were able to access an additional portion of that building for an incremental increase in your cost, then that would be basically a new lease. You would do the calculations based on the new lease and record it as such. If that's basically as long as you know both those things occur, you're getting more assets, a bigger piece of an asset, and you're paying an incremental amount that is commensurate with what the value is of the new portion of the new assets that you're getting. It's not a new lease if basically there's and in this case, you just have to reassess the term. If there's a significant event or a significant change in circumstances that's within the control of the lessee that directly affects whether the lessee is reasonably certain to exercise or not exercise an option to extend or terminate the lease. So that's a case where you know, you may have had an original lease with a 5-year term and 3 5-year extensions at your option. And perhaps initially you were virtually certain that you were going to exercise each and every one of those 3 options. And then 5, 7, 8, 10 years down the road, you determine that, you know what, we've outgrown this facility. There's no way to expand it. We're going to have to move. We're going to have to incur that cost anyway. We're not going to extend that lease. In that case, you would determine when you're going to basically terminate that lease, or if you're not going to, you know, take that last extension, and then just recalculate based on the new length of time that you're using, what the remaining value of that right of use asset is, and what the remaining obligation is going to be on that lease. The same is true if you were in the same circumstance where you had 3 5-year extensions at your option, and the landlord came to you and said, hey, you know what, I'd like to modify this lease. You're a good tenant. I'd like to grant you, you know, 3 additional 5-year extensions beyond that time. And if it's, you know, fairly certain that in your circumstances, you're going to take advantage of that, then you'd want to account for it as such. So you would, again, take the new term. This time it's a longer term. You'd have to recalculate the fair value of the lease liability, as John just showed us, and record, you know, the change to the right of use asset. those are the primary, if there's an event that is written into the contract that obliges the lessee to exercise or not exercise an option to extend or terminate the lease. If the lessee elects to exercise an option, even though the entity had previously determined that the lessee was not certain to do so, again, that's where either you thought you might leave after the second opportunity to extend, but then you determine, no, we're going to stay, or again, if you're offered additional term. Now, you remeasure the lease payments when the lease is modified, and if that modification is not accounted for as a separate contract, you just, again, you recalculate the amounts and make an entry to adjust those balance sheet accounts. A contingency upon which some or all of the variable lease payments that will be paid over the remainder of the lease are based is resolved. So if there was some sort of contingency event and you just weren't sure which way it was going to go, and it has an effect, a significant effect on the ultimate amount that you'd have to pay for the lease or the term of the lease, if that contingency ends up being resolved while you still hold the lease, then you may have to go back and remeasure. Again, I want to reiterate that all of these things are contingent upon the materiality of the circumstances at hand. If there's a change in the lease term, let's see, this is just reiterating. Give me a second. Yeah, it's any changes in those circumstances or in your initial assessments basically would result in a modification. So that's all I have. I know it's a little bit earlier than we anticipated for starting with the questions, but if we have questions, I think it's as good a time as any to get into those.
Thanks, guys. We've either baffled everybody or they understand this completely, because there aren't a ton of questions, but there are a couple. So let me see if I can, whoever wants to take it can take it. So you guys talked about non-lease components, that 21% in the example that you would pull out of your total lease payments. Are those costs like common area, are they generally spelled out in a lease agreement? Or if they're not, how do you calculate them?
I would say that, if they're not spelled out, then they're really just part of your basic lease payment. So they really, I don't think at that point there's necessarily an option, because typically in a lease where you're responsible for those costs, there's some sort of calculation that has to be done. And you typically also have an option to have the right to audit those costs. So, if you have a percentage of a building, you may be responsible for that same percentage of those common area costs. And you have the right typically to go in and view the bills that were paid for common area maintenance, for real estate tax, utilities, those sort of things, if you're obligated. So if you just have a set lease amount in the payment, in the lease, a set payment amount, then I would say there's nothing really to pull out. Now, I suppose you could have an agreement that says, if it's a little bit more ambiguous, that says, here's your lease payment plus common area maintenance plus this and that, and it doesn't really spell out any limits. You would have the opportunity to carve those out. And I would think in those cases, because of the uncertainty, you'd even want to do so, more. It'd be more likely that you'd make that election. So
is it fair to say that you'd like to carve out those common area non-lease costs to keep the liability and the right of use asset and liability numbers down?
I think if I were making that election, that's the way I would go, just because those things are always going to be somewhat variable. And just to make the lease accounting a little bit cleaner, I would like to carve those out. It's easy enough to account for those separately. It's going to be separate payments. Well, I shouldn't say it's always separate payments. A lot of times you are obligated to a certain amount throughout the each 12-month period, and then you have some sort of true up at the end of the year. But in any event, as long as you can identify the amounts, I think it's a little bit cleaner as far as what you record on your balance sheet, the asset and liability, if you carve those out.
Okay, thanks. Can you be a little bit more specific about the impact on financial covenants with the bank which covenants have you seen that you think might get tripped that were passing before?
I think that, those things are going to be so specific with your bank. However, depending on you're going to, for an operating lease, you're going to have something on your balance sheet that looks like debt that didn't exist before. And so if you've got some sort of limitation on incurring debt, you want to make sure that they understand that that's not a new loan. It's an existing lease, and the accounting pronouncement required you to put that on your balance sheet. It's not something new. The other thing is that a portion of that lease liability is going to be in your current liabilities. The current maturities of that are a current liability. You're not going to get the benefit of a current asset. The asset is one line, right, of use asset. Just like with your fixed assets, you don't put part of your fixed assets current because you're going to depreciate a little bit more of it this particular year. So it could affect your current ratio. It won't affect cash flow type covenants. Typically, I wouldn't think, because the cash outflows basically don't change and the expense doesn't really change. But I do think it could have an effect on your current ratio that may be unexpected and unintended, and it have an effect on the appearance of new debt on your balance sheet.
So maybe a debt to net worth calculation?
Sure, yeah.
Okay. Let's see. You mentioned the discount rate. I'm a little confused by I understand the incremental. I'm a little confused by the implicit rate. Is that also spelled out in the lease, in the lease agreement?
I would say it's infrequent. I really can't remember seeing many, if any, true lease agreements, whether they're intended to be capital leases or not, that have an implicit interest rate. It's all basically, here's your lease payment. And I know that the lease company has, they're using some sort of discount rate. They don't always share it with you.
Right.
So that's why I think it's important. If you have no other borrowing, it's going to be a little bit more tricky. But I think John's advice was good. Whether or not you have any borrowing, you do have a banker. And so your banking relationship may be able to tell you that, you know what, and maybe you should do this cost benefit analysis. Maybe you should talk to your bank and say, hey, if I want to buy this piece of equipment rather than lease it, what kind of financing can I get? And he'll tell you what the rate they would charge you is. You'll see what your payments are with the bank, and you may decide that, you know what, I want to buy this piece of equipment instead of leasing it, because the leasing company and the finance company is charging me a higher discount rate.
Good. In the first webinar on leases, you guys talked about that Stowe and Degon does some publicly traded companies, and I'm assuming that you have seen what companies have done in the public world. And can you address any of the key issues that you've seen your clients, our clients, deal with as they roll out this new ASC?
Well, the larger public companies we deal with, they nailed this. They were working on this from the time it was announced, and they didn't really have any issues. We do have some that are smaller and have less sophisticated, less sophisticated accounting functions. And so, understanding all the inputs that go into that fair value calculation to get the obligation and the timing of the payments and what should be included and excluded, because they typically don't plan as far ahead. And so not that it took them by surprise as far as having to implement it, but it took them by surprise, I think, in some cases, as to how much information they needed to gather and go through the calculation, and then to understand the monthly accounting entries that are necessary. As John's slide indicated, it's no longer just credit cash, debit rent expense. You've got to, you're crediting cash, you're debiting the lease obligation, and you're recording the interest expense, and you're recording an amortization of the right of use asset. So it's a little bit more complex. You just have to make sure that you get it set up well initially, and then you do have to stay on top of the new leases that you enter into. Again, in the past, you'd enter into a new lease, and it was a matter of making sure that the bookkeeper, the accounts payable staff, got the information to make the payment each month. But now you're going to have to go through these mechanics to calculate the right of use asset, calculate the fair value. I think the other issue that even public companies ran into is the volume of leases they had. I think some of them had a lot of big companies with a big sales force might have a lot of vehicles or office equipment or whatnot, and they just wanted to make sure that they had controls in place. And again, public companies have their internal controls audited as well. It's important that you have the controls in place to know when you've entered into a lease, so that you don't overlook it, because that's one of the things that could really, pose an issue. I think that, what we see with private companies, that, typically the owners may be more tax driven than financial reporting driven, which is fine for the most part while you're operating your company, as long as you're, understanding that at the end of the year, you may have some audit adjustments. But where that gets a little bit trickier is if you're in a position where you want to have an exit strategy and you're going to be selling your company to somebody that, also has a strong accounting firm behind them. They're going to be looking at how you've done your accounting, and they want to make sure that you're getting it right. So having all these things well documented is very, very important. If you ever get to the point where you want to sell your company or buy another company, they're going to do due diligence as well, and they want to make sure that you understand, what the accounting is supposed to look like, and that you know how to get it done. And that's why we're here. We do this day in and day out. So we want to help everybody that's either an existing client or has circumstances where maybe they should be an existing client, and we can help them prepare for whatever's down the road.
Hey, John, do you have any other comments on that question?
No.
Okay, a couple other questions here, and if anybody has any questions, they can get them typed in here shortly. I'd appreciate it. Sorry if it was presented earlier, but can you aggregate quote unquote like leases for testing purposes? And I know you did, John, but maybe you could run over that again, please.
Yeah, there is an allowance in the literature for you to aggregate and treat on a portfolio basis like leases by asset class. So if you have groups of photocopiers, groups of PCs that you're leasing maybe, or several vehicles that you're leasing, instead of, analyzing each individual lease and setting up a separate right of use asset, you can treat them as one lease. You have to include all the payments, obviously, but yes, you can aggregate leases and use a portfolio approach.
So if you were a privately held company and you leased several offices around the country from related parties or unrelated parties, and the numbers are a lot bigger than a Xerox machine or something, or a car, you can still aggregate those bigger amounts?
I guess you could, but I mean, I would think that would probably be something you would not want to do. Those amounts and those leases would be discrete enough that would probably be worth your while to treat them separately. Okay. This is more to make it easier for smaller leases with, larger amounts of leases, I think,
Okay. We have one more here. We have a small office lease that is on a 12-month term with an option to renew annually. Would this be considered a lease that no change? Would this be considered a lease that no change would need to be made, or does this need to be brought up to the balance sheet under the new standard?
So, it's not just a yes or no question, so to speak. Again, really what it gets down to, and this is spelled out in the pronouncement, in the codification. It basically, you have to look at what is your intent, as well as your ability to discontinue in that space. If it would be not cost effective, if there's a low likelihood that you're going to move at the end of any one of those 12-month periods, then you should consider it a longer term relationship. And so I think that, that's one difference that I think is fairly significant as far as not just the accounting, but the disclosure. Because if you had 1 year leases with an option to renew each year, you didn't really have to go through the tabular form in the footnote showing, here's my expected rent expense under existing leases for the next 5 years and thereafter. But this looks a little bit more at what is the intent and what's your ability. If it's not cost effective to move, if you really wouldn't have the ability to move, if it's just almost impossible to find a new space, and it's just a matter of convenience is why you've got those leases as 1 year, then I think you should apply this pronouncement. We'd have to understand all the facts and circumstances. Every single case has some specific facts and circumstances that could change my opinion as to what I just said. But that's what you have to look at intent and ability to stop using the equipment or the space to determine what the accounting should be.
Okay, I don't see any more questions. Keith and John, thanks for hosting and putting together this a great example. And to all attendees, thank you. I think you hopefully have a better idea what a pain this new pronouncement is going to be, but it is here and we have to all start dealing with it. And we're just asking you not to procrastinate much more than you have. And if you need help, reach out to your contact at Stowe and Degon, and we'll be here to assist. So unless anybody has a last minute question, we're going to say goodbye to everybody and enjoy the rest of your day. And thanks for attending.
Yep. Thank you, everybody.